Hello and welcome to the Mutual Fund Show. My name is Neeraj. Over the next 20 to 30 minutes, we'll discuss all about mutual funds. And as we spoke about when we told as to what we'll do on the show today, we'll speak to two experts on 5 or 6 key burning questions that are minds of a lot of mutual fund investors. So without much ado, let me get them on the show. Amol Joshi of Plan Rupee Investment Services and Amit Bivalkar of Sapient Wealth Advisors join us on the show. Gentlemen, both of you, good having you. Thank you so much for joining in.
Pleasure to be here.
And let me just get straight to the ball because there are a bunch of questions that have come in. We kind of shortlisted 6 questions which we thought were the really more pertinent ones in the current scenario. How to identify issues with debt portfolios, and I'm not surprised that one of the most recurrent questions that was asked was this. Either of you want to start off?
I think more importantly, one has to see that the category where we are talking that there is a problem in debt funds, the name of the category itself is credit risk. So you are aware that there is a risk in the fund what you are investing. I think more importantly, if you look at the total size which is managed by the credit risk funds, it's about 1,33,000 crores, which means if you aggregate it, it becomes the 4th largest bank in the country. Now, if you have the top 3 banks which has 1.5% to 7% NPAs, saying that credit funds will not have NPAs itself is a misnomer. So you will have some accidents going on the way when you are invested into credit risk funds per se. If you hold on to your investments with the maturity profile of the fund, and if your maturity profile and the fund's maturity profile are matching, I think you will still do better than a fixed deposit on a post-tax basis in a credit risk fund.
Okay.
Only thing is, some of the funds have actually done credit risks in the medium term, in the short term, in the liquid plus. So the issue clearly is, have I understood the risk before investing into the fund? That's the job of the client to have a look, and the advisor who has suggested as to which fund you should actually buy. So you should actually look at your time horizon, your maturity profile, and the credit rating of the fund. If you have this in place, I don't think so this problem is as grave as it is actually been seen in the media.
Interesting. Amol, you would want to simplify that for us. How does an advisor, because I believe when I was speaking to a few CEOs, they were saying that there is probably a set of new advisors as well who might find it difficult to figure this out. And then a whole host of investors. How do they try and identify that there is an issue out here with this debt portfolio?
Right. So Amit made a very interesting point that the name of category itself, and that has become very prominent after the last SEBI scheme recategorization. So category itself tells you that there is some kind of credit risk involved in the scheme that I am investing into. That's number 1. Number 2, and this number 2 point is also should be used only as a guiding sort of a point, guiding light. If you are chasing the highest YTM simply stands for yield to maturity for a debt fund. Higher the YTM, more are the chances that the fund holds securities that are rated lower. We all understand that a AAA rated security will probably have to borrow at a lesser cost than a AA or a single A rated security. So other than the scheme name or the category name, the second point that you should look at always is what kind of YTM the fund has. Higher the YTM, more is the likelihood that fund holds lower rated papers. That also could probably one of the points that you could look at.
Okay, concentrated debt portfolios was the other bit that I believe you mentioned as well.
Sure, yes, concentrated debt portfolio. So another important point, either when the investor chooses a fund or advisor recommends a fund to you, it is expected that you will not choose purely based on the past returns. What applies towards equity funds applies equally well towards debt funds as well. So you will not just look at past returns, you will also look at what kind of fund portfolio has been built by the fund manager, whether it sticks to the fund, the mandate of the fund. More importantly, what is the kind of securities that fund has, and what if the securities are concentrated. In the sense, you do not want one particular debt security, a debt paper, comprising, let's say, 8% of the portfolio. It is well below the legal threshold. By legal, I mean regulatory threshold, but still you do not want that. In debt, more the diversification, better off you will be in case any such credit accident takes place.
Even exposures to a particular group, I believe this is an important question, so just spending some more time here.
Yeah.
But the other question, and my follow-up to that is, how do I figure all of this out? Where is all of this information available?
Okay, so Most importantly is, do I actually read the fact sheet which gets published by the mutual fund on a monthly basis? Fact sheets actually disclose you all the information what one needs to identify where am I investing. And when you're giving money, say to anybody, you actually check his background, you do a background ref check of whom I'm giving money and then give money to them. Similarly, in a fund, you should not really trust who is recommending you that fund, but you should actually go into where the money is being invested, what is the pedigree of the fund, what is the history of the fund, has there been a downgrade, upgrade history, what has been that ratio for that particular scheme, and then you should actually go and invest. It's not so that if you have a lower rating, that means the fund is more risky. In fact, a bigger group like an ILFS was a AAA all the time and went to D in one day. So if you try to look at only AAA, it's not that there will be no accidents in a AAA. A AA plus also might be a actual AAA in the market, but it is valued as AA because of financial balance sheet constraints. So what is more critical is I should read the fact sheet. I should also look at the corpus size of the scheme if I'm putting in more money. I should also look at what is the corporate and retail mix of the scheme. So if you have more lumpy institutional investors into the scheme with an event or an accident, those guys actually, they run off the fund and then you are left with probably that only security which becomes more percentile in nature rather than what it was when you invested. So all of this has to be understood, and if you cannot understand this, therefore you require an advisor who can actually do the homework for you and then suggest you something where you can invest.
As we've been saying for the last year and a half, mutual funds is not an easy business, and the last 6 months have shown that even debt funds is not an easy business, probably even more difficult a business as opposed to equity funds, maybe. Okay, let me try and get it down to some specific questions then. Yeah, the next question that was again something that was largely asked when we put out those queries was, how does one approach looking at debt funds or money market funds because of the Z issue which followed the ILFS issue? Amol, you want to start off?
Right. So money market funds, you have mentioned both the names, debt funds and money market. Debt funds is overall the category, the way you have equity funds and many funds under that or many scheme types under that. Within debt funds, I think money market funds, liquid funds, overnight funds are probably the simplest and safest category. So now this topic of the discussion also, I imagine, is because we have had couple of 2-3 credit events in last few weeks. When you talk about money market funds, these funds most of these funds invest in higher or highest rated securities that are, at least Amit made that point, a security if it has a lower rating does not mean that it is a bad security. Similarly, a security which has a better rating, AAA so to speak, it does not mean that you will never have an accident over there. But suffice to say that over a short maturity period of about, let's say, 90 days or so, money market funds, there are very, very less chances that you will encounter something like this. So I would say that if you are really concerned about debt funds and the return delivery or the experience of investing into debt funds, something like liquid, overnight or money market funds are probably best suited for you. One important distinction over there, these funds, when the going is good, when there are no credit, there was a period of time, 2014 to 16, in those 2 to 3 years, I don't think you had any such risk hitting the markets or schemes. In those periods, the credit risk schemes will outperform the schemes like liquid fund or overnight fund. So there is always a compromise between the risk that you are willing to take and the return that you will take home.
Yeah, naturally so. Okay. What would you say? What does one do when you are exposed or when you look at these risks that have come out, a perceived risk or risks that have come out? How does one approach?
So I think what one has to understand is when you encounter such an event in your investment journey, you have to look at actually what is the indenture where I have given money, the trust, the deed. Suppose I as a fund have given money to X company, I have to look at what is the structure I have used when I have given that money. And you can actually ask the fund manager as to how you have lent, what are the covenants of that
But
structure.
The retailer guy can't go out and
exactly.
ask that, right?
So if he can't go, then I have to look at if the company to which I have given money, then is the operating company actually making profits? Or is the parent in a problem but the operating company is doing good? Like in case of SL Group you mentioned, I think the television business and the other businesses are doing well. It's the pledge which is created at the promoter level. So if the operating businesses are doing well, clearly you stand a chance of recovering money from those companies. While in case of ILFS, you had the operating companies itself having an issue while the parent also had an issue. So on the operating company level, if you feel that the company is doing well, then I think you have chances to recover your money. Second thing is, having said this, will you not face a downgrade risk on the portfolio? Yes, you can face a downgrade risk on the portfolio. But if you have that 3-year, 4-year kind of horizon in that fund, I think it gets neutralized over a period of time. So most of the funds, even if in case of ILFS or Z, you might see that as a 8,000 crore number which people are flashing that mutual funds have exposure. If you look at scheme wise, I think it's about 2% to 4% what they have as an exposure in each of the schemes. So for me as an investor in a particular scheme, and if there is a 25% haircut on a 2% exposure, I might be having a hit of 0.5% on the entire portfolio. So it's how you actually look at things and how you explain it, simply put, that actually drives where should I put my money into.
Okay, fair call. So then let's try and get to the beginning of the problem. You're looking at the tail, now let's get to the head of the problem. How does one identify, what does a retail investor do to identify sketchy portfolios? Let me start with you.
So basically one comes into debt funds because they are there is a tax arbitrage. You hold for 3 years and you get a indexation benefit. A retail guy, according to the industry parlance, is somewhere between 1 lakh to 5 lakh rupees of investment. He doesn't come into the 30% tax bracket. So should he really come into debt funds?
No, but let's assume that
so
he's still subject to 30%, right? Because your salary, etc.
So the difference between a liquid fund and the highest risk perceived fund today, if you put a 10-year graph onto this, the difference is 0.5% over the lowest risk according to SEBI and the highest risk according to SEBI. So on a 10-year period, on a CAGR basis, you might be on a liquid fund at maybe 7%, you might be at 8% maximum on a highest risk category in debt. So should I be in a debt fund for getting that extra 0.5% return, or I am okay getting a post-tax return better than an FD, which might not be 7-8%, but I am okay with a 6% kind of return? I think then the CBLO and the liquid fund actually does the trick for you.
Okay.
So how much risk I want to take per unit of investment, if I can identify that, then I can choose the product. And you have got baskets right from 1 day to 5 years, to 10 years, to 30 years. So you have got constant maturity funds of 10-year gilts, which you can invest for 10 years. You have 3-year FMPs, you have 1-year interval funds, you have quarterly funds, you have liquid funds, you have money market funds. So depending on the requirement of money, as we say in case of housing finance company, there should be no asset liability mismatch. Similarly, in case of investments, there should be no maturity mismatch as to when I require the money and which fund I am investing into.
Okay.
So if I require the money for short duration, I should be in short end of the curve. If I require the money after 3-4 years, maybe on the long end of the curve.
Okay, again, the way to pick up the funds, but what does one do? Again, the question that is there in my mind as well, that is there a way for the retail investor to identify that the portfolio might be a sketchy portfolio and therefore I should avoid going into this fund? My time horizon is one thing, or the kind of fund that I take is one thing. But is there a way for me to identify that, hey, this portfolio seems a bit sketchy, let me not go into that? Is there a way to do that?
So I think on the mass scale, just a minute, on a mass scale, if everybody is recommending a particular fund, stay away from the fund. That's the general logic what you should do. But look at the credit quality of the portfolio. If you are comfortable with a AAA higher majority, then the corporate funds today are 100% AAA. Look at banking PSU funds today, which are non-NBFC funds. So you might find comfort into that.
Okay.
Look at liquid funds which do not go beyond 60 days of maturity. You can find comfort into that. Look at the expense ratio of the fund. Look at the corpus of the fund. So you can have these filters and then take a decision. Amol, you want to add?
Sure. So I was going to say that you asked very important question. Which portfolio should I avoid? So there are hundreds upon hundreds schemes in the market. Like earlier we referred to liquid fund, overnight fund and ultra short term fund. If you have a slightly longer sort of investment horizon, you can look at something like corporate bond fund, which Amit just mentioned, as well as banking and PSU debt fund. Now let's talk about banking and PSU debt fund for a bit. As the name suggests, banking and PSU debt fund majoritarily invests into debt securities that are issued by banks, which is nothing but certificate of deposits, and that are issued by PSUs. PSUs, as the typical logic goes over in India, PSUs are considered to be a quasi-government entities and hence safer. These are the sort of funds which you can invest for a 1 year to 5 year, 1 year to 3 year kind of investment horizon as well. These are also likely to generate better than liquid fund sort of returns. So you are neither foregoing the complete benefit of what a credit risk or a accrual fund typically, again use the industry parlance, you are not completely letting go of the additional alpha that will be generated by that. You are somewhere in the middle, and I think that's probably the best way that a retail investor should take, especially because again I'm picking up words from what you said earlier. Retail investor may not have access or may not have the bandwidth capacity to go through all the due diligence that Amit mentioned just now.
Yeah, most importantly, I think that's a problem that I think all our viewers face.
You can purely look at AAA rated fund like a corporate bond fund or a banking and PSU debt fund which invests securities into securities issued only by banks and PSUs, which are, as the traditional wisdom goes, considered to be safest by majority of investors, majority of mutual fund investors.
Okay. There's one more way to do that, and that is to rewind the last 3 minutes of this conversation and hear it again. I think you will get some idea of what you should be doing if you want to kind of identify sketchy portfolios or make an attempt to do that. Okay, a couple of other questions, and one term that's now become really popular, right, or really well known is side pocketing. And I think a lot of people have been talking about, okay, mutual funds are allowed side pocketing. Are they doing it? Why aren't they doing it? If they're doing it, then my money is safe. If they're not doing it, then my money is not safe because they're taking a markdown. I mean, without complete knowledge of what this is about and how will they impact the NAVs, right? I'm worried about the NAV of my viewer who is invested in those funds.
Sure.
So what is side pocketing? How does it impact the portfolio? Amol, let's start off with you this time.
Right. Side pocketing at its simplest is segregation of an asset which has turned illiquid. When an asset turns illiquid, when there is a question mark on the repayment capability of the issuer. In fact, something that you said, if fund is not doing side pocketing, my money is safe. This is completely opposite to what the reality is. If the fund has come to the side pocketing stage, that itself means that there has been a credit event or credit accident in that fund. So side pocketing is probably something which happens when security is on the verge of default or security actually defaults on the date of maturity. Now coming to how does it work? An illiquid asset gets segregated or gets separated from the main portfolio. Amit mentioned in one of the answer to previous question that when a security turns illiquid, then a nimble-footed or investor or institutional investors who have greater access to information as well as execution capabilities would actually bolt at the first sign of trouble. True. And retail investor in most cases is left holding the bag. To avoid that, side pocketing is a measure which is mostly used globally into hedge funds. The illiquid security gets segregated and the entire other portfolio. Again, let me take the example what Amit mentioned earlier. If 2% of your security becomes illiquid, remaining 90% is a well-performing liquid portfolio. So 2 rupees will be separately carved out as a separate portion of the scheme. Remaining 98% of the scheme can continue business as usual, meaning your redemptions will not be hampered. The biggest thing that people want from investment other than the return is the return of capital itself. Return generated by the capital is on top of that, but if you can't use your money when you actually need it, it doesn't serve any purpose at all. So to spare retail investors from this agony of fund having to apply gating again industry parlance,
sure.
Gating simply means that redemptions will not be allowed for so and so period, let's say 10 days, let's say 30 days. To spare retail investors from that, the liquid asset will be segregated and 98% of the remaining scheme can continue business as usual. So that's side pocketing at its simplest.
Do you think funds will do that? You want to add something to that?
Yeah,
otherwise, do you think funds will do that?
Why do you invest in debt funds is because safety of capital, liquidity and then returns. So if you have safety in mind first, then liquidity and then returns. So all of this translates to whether I am getting money when I need it and is my money safe. Am I going to have a capital loss or am I going to earn something on that money? So if you look at side pocketing, the SEBI circular which came out, it actually said that does the fund house had side pocketing as a provision in their scheme information document. Now no fund house when they launched the schemes had side pocketing in there. So today as a fund house, if I say that I am doing side pocketing in the SID, I have to write to all the unit holders, right? Now once I write, that means the unit holder can perceive there is a risk in this scheme. So many funds are saying, okay, let's not do it right now. When it comes, let me go and do it then. I have to also give a exit period of 30 days without exit load in that scheme. scheme because it's a material change for the objective of the scheme. So if I do that, I am fearing that I will lose my corpus. So people are not doing it as of now. Once I have that in my SID, then it's just a trustee approval which I require, and then I can ask that I am moving this asset which has been downgraded below investment grade. So illiquidity is nothing to do with side pocketing. If the security is downgraded below investment grade, then I can only side pocket that security, and the rest of the portfolio can remain open for redemptions or purchases. More importantly, what happens is when I do a side pocketing, I actually avoid that security bulging to higher percentile if there are redemptions into funds. So you have seen in some cases in the last 6 months, some of the securities which were illiquid and downgraded, those remained in the portfolio, and they are today at 20% or 15% or 30% of the portfolio. So people go out if they feel that there is a downgrade risk, but side pocketing will actually allow redemptions and purchases to happen as usual, and they will not have impact on the investors who are staying back into the fund. Plus, when you do side pocketing, it might happen that my company is downgraded to below investment grade, and I stay in the same fund, and then some investors come in and I repay back, and they take away the NAV what I was supposed to get as an investor. So side pocketing will allow to protect the interest of the original unit holder. By doing it, I think it will have an impact on the NAV on a positive side rather than on a negative side.
Okay. We have two more questions, two big questions. So one each to two of you, because we're running slightly short of time. You can pick and choose.
Sure.
Fifth question is how to zero down on debt funds for short-term goals. And the sixth question is any substitute for recurring deposits from the debt fund category. You can, either of you can choose on either.
Whatever.
Yeah, purely as a solution.
So you're going for the zero down on debt funds for short-term goals?
The RD one.
Okay, let's go for the. So let me go to Amit first for the fifth question, which is how to zero down on debt funds for short-term goals.
So I think, as I said, the basketing and the bucketing of mutual fund is very clear after categorization. So 1 day to 5-year money, 10-year money, SEBI has given you buckets which fund can be put into that basket. So if I have anything which is less than 3 months, I think I should stay in liquid funds. If I have 1 year money, I should go into ultra short funds or maybe a low duration kind of. If I have 3-year money, clearly FMPs today are offering a better yield. So FMPs or a short term variety. And if I have anything which to do with 4-year, 5-year money, I think medium-term funds or probably a credit risk fund, if you can stomach the volatility, then you should look. I think you have an opportunity in the crisis, what I see today. If nobody is buying, I think somebody has to go and probably test the water today. You can't paint the entire credit portfolio saying that there is a problem with one particular group, therefore the entire credit risk should be painted bad. So there is an opportunity in risk if you want to take it. And I think more importantly, I should have my maturities carved out as per requirements of funds, and from 1 day to 5 years I can put in any of the categories which I told you.
Interesting. So well defined. You pretty much know this. Again, if you want to know it clearly, rewind the answers and try and figure that out. Amol, any substitute to a recurring deposit from the debt fund category side?
Absolutely. The substitute at its simplest is having an SIP. RD is nothing but recurring deposit, having a recurring investment in liquid fund or ultra short term fund. If you have a 1 year sort of RD in your mind or RD substitute in your mind, I think liquid fund would do well. If you have a between 1 to 3 years, I think something like ultra short duration is the solution for you.
Okay, so keep a SIP into this.
Yes, RD is nothing but recurring deposit.
Right.
So you are planning to invest, let's say, X amount, 5,000, 10,000, 25,000 a month. That amount, instead of going towards bank deposits, you want slightly higher sort of liquidity as well as slightly higher return. Then I think liquid as well as ultra short.
If I have a slightly longer term horizon, say maybe 5 years.
If 5 years, I would say that SIP in low duration fund will do the job here.
So I might say if you have 5 years, why not equity?
Of course. Yeah, because the question is from a debt fund category, which is why. But otherwise, yeah, if you have 5 years, then most people would say just go to equity markets, and equity market funds, they'll probably do well. Okay, these are the 6 questions that stood out the most when we were thinking of conceiving this show. Now, we invited some queries. Some of you have written to us. We'll try and take as many as we can. But let's start off with Rekha's query. She writes us on Facebook, and she wants to know what should one do if the mutual fund has exposure to the SL group. A very specific query. Let's assume she has a fund which has got exposure to the SL group. What should she do?
So as I said, the operating company and the group level, you have to distinguish between the risk at the group and at the operating company level. And if you're comfortable with the operating company level, they are doing profit, they are doing okay, then I think this risk can be nothing more than a downgrade which is possible into the security. But otherwise, if you have that time horizon, as I have been saying, I think you will tide over this crisis.
Okay.
So operating level comfort has to be the main thing when it gets to SL Group here.
Okay, I don't know if you can answer or no, but if you can, do you have the comfort with that?
So I think
this scenario,
I think more importantly, I can look at the balance sheet and say the operating company level is doing well.
Okay,
I should say that.
Okay, fair call. So Rekha, I hope you got your answer. Maybe it's not as problematic a situation as you might have thought, which prompted you to ask this question as well. But it's always good to ask questions. Best to ask questions and know about the thoughts of experts as opposed to not asking it and keeping it within yourself. Pragya also writes to us on Facebook, and she wants to know that after ICRA put 6 debt funds under rating watch, what could be the next course of action and what should investors do?
Right. So the 6 funds that have been put under the watch by ICRA, there have been a markdown on the papers that are held by those securities. Now those securities have the first charge on the escrow account where the funds get deposited. Some of the funds or the accounts or the payouts are guaranteed by states. In the sense, Jharkhand state has guaranteed some of the monies, one of the funds in question. The markdown taken by those 6 schemes is in anticipation of similar action of not paying despite of having the first charge as well as despite of having money in the account. As soon as those fund houses have been, they are going to the suitable authorities to resolve the logjam. So I would say that since it is already, the markdown has already taken place, in the sense the NAV hit has already taken place, there is nothing that you will be achieving by exiting at this juncture. And there is mathematics to what Amit has been saying in this entire program. If you have the investment horizon, what does that mean? If we have a minute, I would like to break it down. Suppose you have, suppose you have completed 1 year in your portfolio. You have generated 7% return. Any random number, let's say 7%. If you are a 30% tax bracket investor, if you exit today, 7% less 30% which you will pay to taxman, your return drops below 5%. Now, Amit already gave an example, so I will not repeat it. But if a 2% security weightage takes 25% or 25% haircut, you lose 0.5%. So over a 3 year, on a yield basis, I am not going into CAGR, on a yield basis, you are going to generate 21 rupees of 22 rupees of capital gains, out of which ½ rupee you lost because of the credit event. Now the indexation comes into the picture.
Sure.
So instead of 6.75% and reducing 5%, again I am assuming indexation at the rate of 5%, you will be paying flat 20% tax on the 2.5% component only, or on 2% component only, which makes your tax at ½ rupee. So instead of less than 5 rupees take away or take home, which you will do by exiting today, if you stay invested for 3 years and take the benefit of indexation, you will be making a healthy 6.5-7% sort of a return. I think that's a very interesting proposition to look at and not exit reacting to one single event.
So everything remaining constant, you might be better placed if you indeed stay put. In the past, such instances have happened, and eventually holding put has actually served the existing investors well, but there could always be exceptions. So it's best to study the portfolio with all the other tools that we spoke about. Sure. And if you don't have the wherewithal to do that, please consult a financial advisor. It's best to do that. The last question that we have time for, Pratham has written to us from Dubai. He has units in a credit risk fund which has holding in a company whose parent company shares have fallen. Is there a risk of a rating downgrade or a write-off?
So I don't know which company or which parent he is talking of. There is always a risk of downgrade. Only thing is one has to understand is what is the percentile exposure to that particular instrument in the fund. And as Amol has mentioned right now, over that time period, will that negate or neutralize the overall effect on the portfolio? So if you are accruing at 7-8% and if you have a 2-3% exposure and if you take a 50% haircut, still over that 3-4 year period, you should not be worried. Okay. So more importantly, all of this is sometimes taking no action is the best action on your portfolio. And if you have stayed invested in a debt fund over 3, 4, 5 year periods, I think you have not come out disappointed on that.
Am I to presume that both you gentlemen, we have probably time for one quick 30-second answer, that these recent spates of quote-unquote crisis that have come in will not have a material bearing, should not have a material bearing on the NAVs over a 3-year period if investors hold on to the papers which some of these funds might be exposed to? Quick 30 seconds.
Yeah, I think so. If you have a mature investor, he will always stay invested in a debt fund irrespective of such accidents. And as I said, you have a large exposure in terms of credit. So accidents will keep on happening.
Sure.
The thing is the time horizon is important of your investment.
Okay, Amol?
Sure. My answer is in affirmative. Over a 3-year, 4-year period, the NAV impact would be minimal.
Okay, fair call. Thank you so much, gentlemen. You know, we asked a couple of mutual fund houses because a lot of queries came in about how are mutual fund houses taking care of the risk in their portfolio. So we asked Radhika Gupta of Edelweiss Mutual Fund and Sandeep Sikka of Reliance Mutual Fund to tell us about the risk management practices adopted by AMCs for both debt and equity class, especially after the Z issue, which was shortly after the IL&FS crisis as well. Here's what they had to say. Well, so AMC houses seem to be confident that they will tide over the crisis as our experts. Gentlemen, thank you so much, Amit as well as Amol, for joining in today and giving us your perspectives. Really appreciate your time. And viewers, thanks for tuning in to this leg of the Mutual Fund Show.